You know, usually when we look at a construction site for a new skyscraper, there's this like comforting, predictable logic to it.
Right. Yeah. You can see it happening.
Exactly. You see the massive hole they dig, the foundation gets poured, and then steel beams go up, floor by floor. And if you're on your daily commute, you can just measure the progress with your own eyes. It makes sense. It's perfectly linear.
Yeah, it's very tangible.
But when you step into the world of big tech infrastructure today, and specifically, I mean, this current just massive hyper cycle of artificial intelligence, that logic is totally inverted.
Oh, completely. It's upside down.
Right. It's as if they're building this sprawling, invisible city completely underground. You can't see the skyline. You can't, admire the architecture. But you sure as hell can see the multi-billion-dollar bill for the excavation equipment.
That is, honestly, that's the perfect way to visualize it.
Yeah.
Because historically, the public markets absolutely hate the digging phase.
Oh, they despise it.
Right. They want to see the penthouse suite. They want that immediate return on invested capital. But, when you are talking about the structural foundation required for generative AI, you are fundamentally reshaping the earth before you can even think about building the tower.
Right. You're laying miles of fiber.
Exactly. Miles of fiber, securing unprecedented amounts of grid power, and deploying custom silicon at a scale we have literally never seen in the history of commercial computing.
And that tension, right, that massive, incredibly capital-intensive underground digging versus the market's demand for immediate visible profits. That is the exact dynamic driving the numbers we are looking at today.
It really is the whole story.
So welcome, everyone, to a special Heised Meat edition of The Deep Dive. Today, we are putting on our Talk Tickers hats.
Love the Talk Tickers format.
Me too. We're going to deliver a very concise, data-forward, and actionable breakdown of a truly massive corporate event, which is Meta Platforms' Q2 2026 earnings call.
Yeah, and there is a lot of noise to cut through on this one.
So much noise. So our mission for you today is simple. We're cutting through the Wall Street jargon to answer the billion-dollar, or I guess $100 billion question for retail investors. Is Mark Zuckerberg's aggressive spending on AI actually paying off, or is it just a giant money pit?
That's what everyone wants to know.
So we're doing a rapid-fire analysis. We've got the numbers, the story behind them, management's future outlook, and we'll give you a definitive bottom-line verdict for your portfolio. So let's jump right into part one. The headline numbers.
Let's do it.
If they are building this invisible underground city, we first need to look at the revenue engine just to see if they can even afford the concrete, right?
Yeah, spoiler alert, they can.
Yeah, they really can. Looking at Q2 2026, total revenue hit a staggering $60.8 billion.
That's billion with a B.
Billion. That is a 28% increase year over year.
And, if you look at it on a constant currency basis, so stripping out all those foreign exchange fluctuations, it's still 27%.
Which is wild.
It's mathematically staggering. Just to contextualize that for a moment, for you as an investor, when a company is operating at the scale of tens of billions of dollars a quarter, sustaining near 30% top-line growth defies the normal laws of corporate physics.
Right, because usually growth is supposed to naturally decelerate as the denominator gets larger.
Exactly. I mean, adding roughly $13 billion in net new revenue compared to the same quarter last year, that is the equivalent of spinning up an entire Fortune 500 company out of thin air in just 90 days.
Just absolutely insane scale. And earnings per share, EPS, came in at $6.18. And the absolute behemoth in the room, the thing driving almost all of this, is the family of apps segment.
I feel.
Right. So we're talking about the core ecosystem, Facebook, Instagram, WhatsApp, Messenger, Threads. That segment alone pulled in $60.4 billion.
Which is basically the whole pie.
Exactly. And if we drill down strictly into the ad revenue within that, that hit $59.4 billion, which is also up 27%. So the top line is just screaming growth. The ad machine is humming.
It is humming, but...
But yeah, I want to pump the brakes right here. Because when you dig into the profitability metrics, there is a massive pothole in the GAAP operating income.
Ah, yes. The $18 billion figure.
Right. GAAP operating income came in at $18.8 billion. Now, on the surface, $18 billion in quarterly profit sounds amazing. But look at the year-over-year comparison. That is actually an 8% decline.
Yeah.
An 8% drop in operating income. Now, when you see top-line revenue surge by 28%, but operating income drops by 8%, that usually signals a severe structural problem, right?
It's usually a giant red flag.
Yeah, it suggests margins are collapsing, or the cost of goods sold is spiraling, or the core business is just failing to flow that new revenue down to the bottom line. So what is actually going on under the hood here?
Well, this is exactly why we have to translate the noise in the numbers for you, because a surface-level algorithmic read of an 8% decline would absolutely terrify a retail investor.
That panics.
Rightfully so. But when you pull apart the 10Q, you see it is not an operational failure at all. It is a strict accounting reality driven by two very specific, massive one-time hits to the ledger.
Okay, yeah, I see the line items here. First up, Meta took a $2.4 billion charge related to legal proceedings in the second quarter.
Yes. Now, they didn't detail exactly which specific settlement or fine triggered this in the prepared remarks, but management did explicitly mention ongoing youth-related trials in the U.S. and, just intensifying regulatory scrutiny across several international markets.
Makes sense.
But regardless of the exact breakdown, a $2.4 billion legal hit is a massive sum taken straight out of the operating income.
Right. And then second, they recorded a $1.2 billion severance expense.
Right.
This is tied to a headcount reduction they executed back in May 2026, which impacted roughly 8,000 employees across various divisions.
Yeah, the CFO, Susan Lee, mentioned they ended the quarter with 75,000 employees, which is down 3% sequentially from Q1. She also noted that the majority of those impacted employees will be completely off the books by the end of Q3.
Okay, but I have to push back on this narrative a bit.
Okay, let's hear it.
I hear you that it's a one-time severance package and a massive legal hit. You can strip them out to find the nice, neat, adjusted number. But $2.4 billion in legal fees, that's not a rounding error.
No, it's not.
That's a significant chunk of their total profit. So doesn't that suggest a systemic regulatory risk that investors absolutely should be baking into the operating costs going forward, rather than just waving it away as a one-time anomaly?
That is a highly astute challenge, and you are absolutely right to be skeptical here. The regulatory friction is not going away anytime soon.
Right.
I mean, operating a platform with 3.6 billion daily active users means you are essentially a digital nation state.
Basically.
And you are going to be in perpetual litigation with actual nation states. It is a cost of doing business at that scale. However, from an equity analysis perspective, we have to separate the persistent operational margin, like the cost to run the servers, pay the engineers, acquire advertisers, from these lumpy episodic regulatory fines.
I see.
The reason analysts script those out is to answer one specific question. Is the core product still generating cash efficiently?
Okay, so if we do strip out that $3.6 billion in combined legal and severance hits, what does the actual operational health look like?
If you adjust for those specific non-recurring charges, their operating income would have actually increased by 9% year over year.
Okay, wow. So an adjusted 9% income increase on a 28% revenue surge. That means they're absorbing billions in structural friction and still expanding the profit pool.
Exactly. The core machine is highly resilient.
But that points us to the absolute crux of the issue and part two of our deep dive, the story behind the numbers. Because if the core machine is running that hot, we need to understand the mechanics of why. What exactly is fueling this massive top-line growth?
Right. To understand the growth, we really have to look at the intersection of supply and demand in their ad auction. Because the data shows a massive, undeniable win in ad efficiency.
Okay.
The total number of ad impressions served across all their apps grew by 14%.
But here's the critical data point. The global average price per ad increased by 12%.
Yes, and that combination is the holy grail for a digital advertising business.
Because normally that shouldn't happen, right?
Exactly. Usually, basic economics dictates that if you drastically increase the supply of an asset, like, say, flooding the market with 14% more ad impressions, the clearing price for that asset drops.
Right. Supply goes up, price goes down.
But Meta somehow managed to increase the volume of ads shown while simultaneously convincing advertisers to pay 12% more for every single placement.
It's wild. And Susan Lee, she attributed this to, better macro conditions than last year, some currency tailwinds, but primarily she pointed to ad performance gains. And this is where we really have to translate the tech jargon, because Mark Zuckerberg and Susan Lee spent a significant portion of this call hammering home the idea that their AI infrastructure is not just some speculative future research project.
Right, it's not vaporware.
It is actively generating yield today. Susan Lee talked about a paradigm shift using something called the meta-generative recommender. So let's break this down. How is this actually different from the algorithms they've been using for the past decade?
Okay, so this is perhaps the most important technical shift discussed in the entire transcript, and it explains that 12% price hike perfectly.
I'm all ears.
To understand why the meta-generative recommender is a paradigm shift, you have to understand the architecture of legacy ad retrieval systems. Historically, these platforms used a highly rigid, deterministic scoring system.
Like rule-based coding.
Exactly. You log on to Instagram, and the back-end system looks at an inventory of millions of active ad campaigns. It used hard-coded tags to score every single ad against your profile. Like, does this person have the likes shoes tag? Yes. Score the shoe ad highly.
Got it.
It was a highly transactional, one-to-one matching game based on explicit historical actions.
So the old system relied entirely on past behavior to predict future intent. If I clicked on a coffee mug yesterday, it assumes I want 50 more coffee mugs today.
Precisely. We've all been chased around the internet by a pair of shoes we already bought.
Yes, it's so annoying.
It lacked nuance. But what Susan Lai is describing with the meta-generative recommender is the deployment of large language models, or LLMs, directly into the real-time ad retrieval stack.
Wow.
An LLM doesn't just look at rigid tags. It uses vector embeddings. It maps semantic space. It turns both your shifting user behavior and the actual creative content of the ad into highly complex mathematical coordinates.
Okay, so instead of a blunt instrument, it's finding hidden correlations that a human coder could never write a rule for.
Exactly. It can understand the deep context of the ad, the aesthetic vibe, the subtle nuances of the imagery, the implied lifestyle of the product.
Yeah.
And simultaneously, it reasons about your complex real-time preferences. It looks at the fact that you hovered over a video about hiking in the Pacific Northwest for, say, 4 seconds longer than your baseline average. And it combines that with the fact that you recently read a text-heavy post about sustainable fabrics. It processes all of that in milliseconds and matches you with an ad for a new brand of eco-friendly hiking boots that perfectly aligns with your current unspoken state of mind.
That is almost scary good, like a hyper-observant personal shopper. And because it is making these high-probability, hyper-relevant matches, the actual outcome for the advertiser improves dramatically.
Oh, massively.
The transcript gives us the hard numbers on this deployment. By shifting to this generative model, they saw an 8.3% increase in ad clicks and a massive 15.7% uplift in conversions on Facebook.
And we have to pause there. That 15.7% metric is the most important number in the entire earnings call.
Really? Why?
Because a conversion means the end user actually took out their credit card and bought the item, or downloaded the software, or submitted a lead generation form. That is the only metric that truly matters to a performance marketer.
Right. Because if I'm an advertiser and Meta's new AI stack makes my campaign 15% more likely to result in actual trackable revenue, I will happily endure a 12% increase in the cost of the ad.
Exactly.
The return on ad spend is still netting out positive for me.
Precisely. The AI is essentially creating alpha for the advertisers. And management made this very concrete on the call with a specific anecdote. Susan Lee highlighted a company called Underneat.
Oh yeah, an online apparel brand based in India, right?
Yes. Now, Underneat used to run their campaigns the old-fashioned way, setting up ad sets manually, tweaking daily budgets, running A/B tests on audiences, basically guessing which demographic would respond best to which shirt.
Which takes a ton of time and resources. A ton of time. But then they fully adopted Meta's Advantage plus Automated Suite, which is powered by these new generative models. They basically handed over the targeting, the placement across different apps, and the budget optimization entirely to the AI.
Just here's my money, figure it out.
Exactly. And the result for Underneat was a 13% incremental lift in total purchases and a 16% increase in add-to-cart conversions.
That's huge for a small business.
Yeah.
And the broader implication here is ecosystem lock-in,
A
right?
huge lock-in.
The transcript explicitly stated that over 9 million small businesses are now using at least one of Meta's AI creative tools. They are using AI to instantly generate alternative background images, dynamically test text variations, format videos for different screen ratios.
Which fundamentally changes the competitive landscape for small and medium-sized businesses. It drastically lowers the barrier to entry for high-quality creative output.
But from Meta's perspective, it creates an incredibly sticky product. I mean, if Meta's AI is generating your ad creative, optimizing your bidding strategy, finding your most lucrative customers, and doing it all with a higher return on investment than you could ever achieve manually,
Yeah.
you're not taking your marketing budget anywhere else.
No way. You are locked into their infrastructure.
Exactly.
Okay, so the AI is clearly driving the core advertising engine, but let's look at the other revenue streams they discussed, because ads aren't the only thing growing.
Right.
Let's talk about WhatsApp. Other revenue for the family of apps hit a historic milestone this quarter. For the first time ever, it crossed $1 billion in a single quarter.
And that's up 73% year over year.
73%.
This is a monumental shift. For years, the market has harped on the fact that Meta paid $19 billion for WhatsApp back in 2014 and struggled to meaningfully monetize its massive user base without ruining the encrypted, ad-free experience.
Right, because you can't just slap a banner ad in the middle of a private text thread with your family.
Exactly. People would revolt. But this 73% surge proves they have finally cracked the code, and it's driven heavily by paid messaging for businesses and premium subscription.
Oh, okay.
Businesses are willing to pay per message to communicate directly with customers on the platform they already use all day.
Which is super smart, and that perfectly sets up the third major revenue narrative. Reality Labs.
Reality Labs.
This is the division that has historically been the punching bag for Wall Street, right? Because it burns billions of dollars a quarter on Mark Zuckerberg's metaverse vision.
It's been a tough sell.
But surprisingly, Reality Labs actually brought in $431 million this quarter, up 16%. Now, what really caught my eye in the transcript was where that growth came from.
Yeah, this was fascinating.
Management revealed that the revenue bump was driven by strong sales of their Ray-Ban AI smart glasses, which completely offset slumping sales of their Quest VR headsets.
And we need to spend some time here, because this represents a massive strategic pivot in consumer hardware. Well, for years, the thesis was that the future of computing was fully immersive virtual reality. Putting on a heavy headset and blocking out the physical world.
Right. But immersive VR is high friction. It's isolating. You can't wear it on the subway.
Exactly.
Yeah.
But ambient AI, which is what the Ray-Ban glasses represent, is fundamentally low friction. You wear them just like normal sunglasses, but they have multimodal AI, specifically the new MuSpark models running on them.
Oh, wow.
They can see what you see, hear what you hear, and interact with you conversationally without requiring you to look at a screen.
And the cultural adoption is really fascinating to watch. They specifically highlighted the new collaboration with Kylie Jenner in the earnings call. That is not a minor detail. When you partner with Kylie Jenner to market smart glasses, you are aggressively repositioning wearable computing from a niche, nerdy tech gadget into a fashion-forward lifestyle accessory.
It signals that the form factor has finally caught up to the function. And technically speaking, running multimodal AI locally on a wearable device, or even seamlessly bridging the local hardware with edge computing, is incredibly difficult.
I bet.
But because the glasses are lightweight, stylish, and genuinely useful for tasks like, taking POV photos or asking the AI to translate a menu you are looking at, consumer adoption is accelerating faster than anyone anticipated.
Wow.
It is proving that augmenting reality is a much more viable immediate path to hardware dominance than replacing reality with a digital metaverse.
Okay, so we've established that the core business is highly profitable, ad efficiency is skyrocketing due to AI integration, WhatsApp is finally generating meaningful revenue, and they have a surprise hit with their AI glasses.
Basically, the current business is an absolute cash printing machine.
Right. But that brings us to the third critical phase of our analysis, part 3, management guidance. We know what they made today, but how much are they planning to spend tomorrow?
And this is where the transcript gets truly breathtaking, because the scale of their planned infrastructure investment is unparalleled in corporate history.
So let's run the numbers. For Q3 2026, management projects revenue to remain incredibly healthy, guiding between $61 billion and $64 billion.
Solid.
They did raise their full year 2026 total expenses to a range of $165 billion to $169 billion, mostly to absorb that $2.4 billion legal hit we discussed earlier.
Right.
But then we get to the absolute jaw-dropper, the capital expenditures. Management narrowed their 2026 CapEx guidance to a staggering $130 billion to $145 billion.
Just let that number sink in for a second. $130 billion minimum.
To put that in perspective for you, $130 billion is more than the entire gross domestic product of many sovereign nations.
Unbelievable.
And Meta is spending it in one single calendar year purely on physical assets. So explain the physical reality of this capex to us. What exactly is $130 billion buying? Are they literally just burying cash in the desert?
In a strictly industrial sense, yes, they kind of are. They are pouring it into the physical, heavy industry manifestation of the internet.
Okay.
CapEx at this scale is not about software development. It is about steel, silicon, and electricity. They are buying hundreds of thousands of highly specialized, incredibly expensive graphical processing units, GPUs, from companies like NVIDIA and AMD.
And these aren't the chips in your laptop, right? These are massive, power-hungry processors designed specifically for parallel computing.
Exactly. And you can't just plug these chips into a standard wall outlet. They are building sprawling, warehouse-sized data centers just to house them.
Wow.
And because the new generation of AI silicon runs so hot, traditional air cooling is no longer sufficient. So they're having to retrofit and build entirely new facilities with direct-to-chip liquid cooling architecture.
Liquid cooling for whole warehouses.
Yes. They're securing massive amounts of water rights for cooling towers. And most importantly, they're securing unprecedented amounts of grid power.
Right, because training a foundational AI model, like the Mu Spark 1.1 they just released, requires crunching petabytes of unstructured data over weeks or even months of continuous computing.
And Susan Lee was very explicit on the call about their philosophy regarding this spend. She stated that management is deliberately trying to maximize their compute capacity for 2026 and 2027.
Maximize, not optimize.
Exactly. They aren't trying to build just enough to get by. They're trying to build as much as physically possible. Why? Because, in her words, the tech industry has historically underbuilt for this wave of AI adoption, and they expect overall industry compute capacity to remain tightly constrained for the foreseeable future.
Wow, so they are essentially looking at the landscape and saying, we might not know exactly what the perfect killer AI consumer app will look like in 2028, but we know beyond a shadow of a doubt that whoever owns the most raw computing power will win the era.
That's it. It is a blatant arms race, and compute is the new uranium.
That is exactly the dynamic. And to prove just how capital intensive this arms race has become, we have to look at the specific infrastructure deal they announced on the call. Meta is forming a strategic joint venture with BlackRock to build a massive 1 gigawatt data center in El Paso, Texas.
Yeah, that was a huge announcement.
Let's pause on that spec for a second. A 1 gigawatt data center. A gigawatt is a billion watts. That is roughly the energy capacity of a full-scale nuclear reactor.
It's insane.
That is enough power to run a medium-sized city of hundreds of thousands of homes. And Meta is building a single facility that will consume all of that power 24 hours a day just to run artificial intelligence calculations.
And the engineering reality of a 1 gigawatt facility is mind-boggling. You don't just connect that to the local municipal grid.
No, I imagine not.
You are essentially building a bespoke utility substation just for the silicon. It requires localized power purchase agreements, likely massive investments in adjacent renewable energy generation to meet their carbon goals, and heavy transmission infrastructure.
But the partnership aspect is what's really intriguing to me. Why bring in BlackRock? Meta has $18 billion in quarterly operating income. They have the cash.
Partnering with BlackRock is a very telling macroeconomic signal. BlackRock is the world's largest asset manager, and they manage trillions of dollars for institutional clients who are desperate for long-term, stable, high-yield infrastructure investments.
Oh, I see.
By bringing them in, Meta is acknowledging that the capital requirements to build the physical foundation of the AI era are so vast, and the power agreement spans so many decades, that even a mega-cap tech company wants external institutional partners to help shoulder the upfront financing and spread the geographical risk.
Interesting.
To BlackRock, a Meta data center with a guaranteed 20-year power draw is essentially a high-yield, fail-safe utility bond.
But this immense scale brings me to the ultimate reality check for the investor.
Right, the so what?
Exactly. If I am holding this stock, I have to ask, are they just burning billions of dollars on a vanity project? The numbers dictate a bullish stance today based on the current ad revenue, but the execution risk of building $140 billion worth of physical infrastructure in a constrained supply chain environment is immense.
A massive risk.
If NVIDIA delays a next-generation chip architecture, or if there is a massive bottleneck in industrial transformers for these data centers, this entire timeline slips. So is there a concrete mathematical plan to monetize all these liquid-cooled servers? Or is Zuckerberg just trying to build the coolest AI lab in the world?
That was the exact tension underlying every analyst question during the Q&A session. They wanted a roadmap to return on investment. And if you synthesize Zuckerberg's responses, he laid out a very specific, highly pragmatic, three-pronged monetization strategy.
Okay.
They are not just building it and hoping the revenue magically appears. They have distinct funnels.
And that leads right into the first prong. Let's break these down.
Prong number one is the core business. We already touched on this with the meta-generative recommender, but it goes beyond just ads. It is about making the organic feeds, specifically short-form video like Reels, more engaging and addictive. Every single ounce of intelligence they squeeze out of those new gigawatt data centers goes into making the content matching better. Susan Lee noted a remarkable stat. Over half of all recommended content on the Instagram feed is now less than 1 day old.
Wow.
And they're pushing massive real-time ranking improvements.
Right, because if the AI is smart enough to instantly understand the context of a video uploaded 10 minutes ago and match it perfectly to my current interests, I spend more time scrolling.
Exactly.
Better content matching equals more time on the app, which equals more ad impressions, which are matched better by the AI, which equals higher prices for the advertisers.
It's a closed-loop money machine, and the ROI is immediate and trackable today.
Incredible. Okay, what's prong two?
Prong number two is consumer agents. This is the structural shift from typing keywords into a search bar to conversing with a deeply integrated personal assistant.
Okay.
Zuckerberg envisions a world where billions of people have an AI agent working 24/7 on their behalf, helping with daily scheduling, health tracking, commerce, and creative output.
He called it personal superintelligence.
Yes.
Right.
And the sheer advantage Meta has is that the distribution channel for this superintelligence is already built and universally adopted.
It's WhatsApp.
It's WhatsApp. Zuckerberg noted an unbelievable metric on the call. WhatsApp just hit an all-time messaging record, peaking at 30 million messages sent per second during the recent World Cup final.
30 million messages a second.
Yeah.
From a network engineering standpoint, the O-line distribution and queuing theory required to handle that kind of burst capacity without the servers melting down is a miracle in itself.
Oh, it proves their infrastructure is bulletproof.
Yeah.
And WhatsApp is already the leading surface globally where people are testing and engaging with Meta AI.
Right.
They just rolled out an incognito mode for private, ephemeral conversations with the AI. If Meta can integrate a highly capable, contextually aware AI assistant into an app that billions of people already trust for their most intimate conversations every single day, the monetization opportunities are vast.
Yeah, definitely.
Whether they monetize through premium tier subscriptions, seamless commerce integrations, or completely new business models, they will own the primary interface between the user and the digital economy.
Okay, so prong one is supercharging the ad machine. Prong two is the personal superintelligence in your pocket. That leads right into the third prong.
Enterprise.
Yes, enterprise. Zuckerberg was talking about selling this intelligence directly to other businesses. I saw the Movida rental car example in the transcript, which blew my mind. Walk us through how that actually works in practice.
Okay, so Movida is one of the largest rental car companies in Brazil. Historically, if a customer wanted to rent a car, they faced massive friction. They had to download a specific app, create an account, navigate a clunky user interface, or, wait on hold for 20 minutes to speak to a human representative.
Which is the worst.
Right. But Movida deployed a Meta business agent directly onto WhatsApp. Now, the customer just texts the company's verified WhatsApp number using natural language.
Just normal text.
Just, I need an SUV at the Sao Paulo airport next Tuesday for 3 days. The AI agent understands the intent, checks real-time inventory, handles the vehicle selection, facilitates the payment processing, and confirms a reservation all in a single, fluid text conversation.
And the business results were staggering. Movida recorded a 44% increase in daily bookings through WhatsApp compared to the previous year.
Yeah.
But the craziest part was that 85% of those conversations were resolved entirely by the AI from start to finish, with zero human assistance required.
That represents a massive leap in operational efficiency for the enterprise. You are eliminating customer service bottlenecks and capturing high-intent leads instantly.
Right.
Now, multiply that efficiency gain by the millions of businesses operating globally. Meta stated on the call that they already have over 1 million businesses actively using Meta business agents every single week.
Wow.
They are introducing a robust back-end platform that gives enterprises the infrastructure to build, customize, and deploy these agents at scale. Over time, Zuckerberg's vision is a business-in-a-box architecture.
So a small business essentially runs its entire customer-facing operation through Meta's AI stack.
Exactly.
And the revenue model for Meta on that enterprise side.
It will likely evolve. Initially, it involves SaaS-style subscriptions or volume-based pricing for API access. But eventually, they could shift to a performance model, much like their current ad system, where a business only pays Meta a premium when the AI agent successfully completes a sale or books a confirmed reservation.
That makes a lot of sense.
Furthermore, they're opening up their API to let developers access their raw Muse Spark models directly. Zuckerberg even casually mentioned that they were receiving unsolicited offers from other companies desperate to just rent out Meta's excess compute capacity at a massive premium over what Meta initially paid for it.
Wait, really? Other tech companies are so starved for GPUs that they're just trying to rent server space from Meta's data centers?
Yes. Because as we discussed with the El Paso facility, industry capacity is incredibly tight. Compute is the most valuable commodity on Earth right now.
Wow.
Meta has amassed so much of it that they could effortlessly pivot to being a massive cloud provider tomorrow if they wanted to. Though, as Zuckerberg noted, the profit margins are significantly higher if Meta uses that compute to generate proprietary intelligence and sells the results of that intelligence, rather than just renting out the raw processing power.
Okay, let's step back and look at the whole board here. We've gone through the massive top-line beats. We've contextualized the reality of the GAAP operating decline. We've broken down the deep engineering mechanisms of how generative AI is supercharging their ad targeting. We've stared into the abyss of a $145 billion CapEx bill and gigawatt data centers, and we've analyzed the 3-com strategy to pay for it all. This brings us to part 4, the bottom line. What is the actionable takeaway for the investor listening to this right now?
Looking purely at the data and the strategic execution outlined in this call, the signal is unequivocally bullish.
But it's a bullish signal that requires a completely updated mental model of what you are actually investing in, right?
Exactly.
If you are holding the stock, you have to realize that Meta is no longer just a consumer social media company relying on serving you targeted ads for sunglasses while you scroll through your cousin's vacation photos.
No, that era is over.
They are aggressively transforming into a full-stack, vertically integrated technology and infrastructure powerhouse.
And that full-stack distinction is vital to understanding their competitive moat. Mark emphasized this repeatedly during the Q&A. They aren't just building neat software applications on top of someone else's cloud infrastructure.
Right.
They're designing their own custom silicon architecture. They are pouring the concrete for the data centers. They're writing the low-level systems code to manage the liquid cooling. They are training the foundational open weight models from scratch.
Yeah.
And crucially, they already own the global distribution channels, Facebook, Instagram, WhatsApp, that reach 3.6 billion people every single day.
That end-to-end integration from the power grid to the pixel on your screen is a massive structural advantage.
Huge advantage.
Now, we have to acknowledge the risks. A $140 billion CapEx bill would absolutely terrify investors of a lesser company.
Oh, completely.
If a legacy auto manufacturer or an aging tech conglomerate announced they were spending $100 billion on a sudden pivot to AI, their stock would crater because the market would have zero faith in their ability to execute that transition without just, setting the cash on fire.
But Meta has earned a rare benefit of the doubt from the market, precisely because they have proven they can generate immediate, trackable return on investment from their foundational AI spend.
Right. Going back to that conversion number.
We cannot stress this metric enough. The 15.7% uplift in ad conversions is the proof of concept. The meta-generative recommender actively matching complex user intent is the proof of concept. The 9 million small businesses integrating AI creative tools is the proof of concept. They are not asking investors to hold their breath and wait until 2030 to see if this AI stuff actually works. It is actively inflating their profit margins and driving that 28% top-line growth today.
So to summarize the entire financial narrative for you, they are successfully using the absolute cash printing machine of the legacy digital ad business to entirely fund the construction of the future's AI infrastructure.
Yes.
They are building the 1 gigawatt data centers. They are partnering with BlackRock to secure the power grid. They are pushing the boundaries of wearable hardware with Ray-Ban. And they are doing all of this while still growing their daily active user base to 3.6 billion people. It is an incredibly massive, almost hubristic bet on the future of computing.
But it is a bet backed by pristine, ruthless execution.
Absolutely.
I mean, they are navigating severe regulatory headwinds, swallowing multi-billion-dollar legal hits, enforcing strict headcount discipline where necessary, and still managing to accelerate revenue growth at a scale that defies standard corporate physics.
Yeah.
From a rigorous fundamental analysis perspective, despite the supply chain risks inherent in building this much physical infrastructure, they're checking almost every single box you want to see in a mega cap tech company navigating a generational platform shift.
Well said. We've broken down the numbers, we've translated the engineering jargon, and we've weighed the risks against the execution. But before we wrap up this deep dive, we always like to leave you with a larger philosophical question to mull over.
Something to chew on.
Exactly. Something that builds on the source material we just covered, but forces you to think about the long-term structural implications for the broader economy.
And there is a fascinating, almost contradictory tension in Mark Zuckerberg's broader strategy that deserves real critical scrutiny.
What's that?
During his prepared remarks, and referencing a lengthy op-ed he recently published, he explicitly stated that Meta is the only major technology company actively trying to distribute superintelligence directly into people's hands.
Right. He leaned very heavily into this narrative on the call. He consistently contrasted Meta against their primary competitors who are centralizing their most powerful AI models behind closed doors and expensive paywalls. He framed Meta as the ultimate champion of the open ecosystem, releasing their Muse Spark models widely so that developers, researchers, and startups everywhere have the power to shape the technology. He literally stated, that's the way that society has always made progress.
But here's the provocative thought we want you to explore on your own. Is that narrative entirely true?
Let's dig into that.
Meta is releasing open weight models, yes. They are democratizing the software layer. But they are simultaneously spending $140 billion to utterly dominate the physical infrastructure required to run those models at scale.
Right.
They are building the 1 gigawatt data centers. They are designing the proprietary custom silicon. They own the Ray-Ban AI glasses hardware ecosystem. And most importantly, they tightly control the primary distribution channels, the actual apps where 3.6 billion people will ultimately interact with this AI on a daily basis.
So the question you have to ask yourself as an investor and a consumer is this. By giving away the baseline AI software models for free, but aggressively monopolizing the ultimate hardware, the massive data centers, the power grid contracts, and the primary consumer distribution channels, is Meta actually decentralizing power?
That's the billion-dollar question.
Right. Or are they brilliantly commoditizing the software layer just to ensure that they can build a more impenetrable, inescapable infrastructure monopoly than ever before?
It is the ultimate strategic paradox. If the underlying intelligence model is free, but you absolutely rely on Meta's localized servers to run it efficiently, Meta's glasses to see it ambiently, and Meta's apps to share it globally, who really owns the future of the internet?
That is the structural question to keep asking as you watch this AI arms race unfold over the next decade. The top-line numbers are thrilling, the generative technology is breathtaking, but the ultimate structure of global digital power is still being built.
Built down there in the dirt.
Entirely out of sight, underneath the visible skyline. Thank you so much for joining us for this deep dive into Meta's Q2 earnings. We hope we helped you cut through the noise and understand the mechanics behind the metrics. Keep questioning the numbers, keep questioning the narratives, and we will catch you on the next one.